Hello everybody, welcome to the latest edition of our research video series. For today, we are going to address the most important risk event for 2019, that of the US-China trade war. We have with us today our economist, Ms. Ho Wei Chen, and our FX strategist, Mr. Peter Cha. Both of them will endeavor to address some of the key questions that we all have. Wei Chen, can you give us a quick update of what is going on with the US-China trade negotiation and also what we can expect going forward?
The US and China have now taken a tougher stance in the trade conflict. Currently, the US imposes an additional tariff rate of 25% on nearly half of Chinese goods exports to the US, whereas China imposes an additional tariff rate of 5 to 25% on nearly all of US goods exported to China. And currently, US is in the process of expanding the additional tariff to include the remaining 300 billion of goods from China exported to the US. And we see potential for this trade conflict to expand into the areas of investments and technology. At the G20 meeting at the end of June, both leaders will be meeting, and we see that there is potential for further escalation. In that case, the additional US tariff could be implemented fairly quickly. If there is a de-escalation in the trade tensions, we could have similar trade truce like what we had seen in December 2018.
Sounds like there's a bit of uncertainty heading into the G20 meeting. Now, in terms of the economic impact, what can we expect for China and Singapore?
We see a protracted negotiations in our base case. And even if there is some resolution to the trade tensions, the additional tariffs might not be totally removed. So there is a lot of uncertainty in the global environment, and for businesses, they are increasingly expected to pass on this higher cost to consumers, and also will be holding back their investments on the capital. This means that there will be a negative impact on growth. As for China, we see the potential for growth to come in at below 6% for this year from our current forecast of 6.3%. And for the case of Singapore, we see the potential for growth to come in below 2% for this year.
Thank you, Wei Chen. Now, Peter, we heard from Wei Chen there may be growth slowdown coming for Singapore and China. Let's address the elephant in the room. What can we expect for the renminbi? Is it going to fall below 7.0 this time?
Previously, there was some expectation of a trade deal, so the sudden change of events dealt a swift and heavy blow to the RMB. In the month of May, RMB gave back all the gains for the year and is now expected to stay weak. We're expecting a range of 6.8 to 6.95 against the US dollar. So back to the question, yes, there's increasing risk that RMB could weaken beyond 7 if trade tensions do continue to escalate. However, the authorities are there to smooth the volatility as they pledge to keep the RMB stable.
So looks like there's going to be a bit of uncertainty for the renminbi. Now, what about the rest, the key Asian currencies like the Singapore dollar and of course ASEAN currencies like the Malaysian ringgit, Thai baht and Indonesian rupiah?
China is a big buyer of goods and products from the rest of Asia. The slowdown in regional trade is likely to hurt Asian currency as well. So for example, the Sing dollars, which track very closely to RMB, has fallen to 138 against the dollar, and a further move towards 140 may not be something of a surprise. Similarly, for other Asian currencies like the ringgit has moved to 418, rupiah has moved to 14,400, and the baht is weaker towards 3180 currently. And we expect a further 2 to 3% drop from here.
Ladies and gentlemen, we heard from both Wei Chen and Peter about their analysis of the US-China trade situation. Going forward, it is our wish, of course, for the authorities in Beijing and Washington to work together in level heads for the greater good of the global economy. If you do have any more further queries, do download and read our macro and market strategy reports.